Hello everyone and welcome to 2021. Phil Seymour here, Company President at IBA. Thanks for joining us today and Happy New Year to everyone. Ordinarily, of course, we'd be providing this update ahead of a fun-packed week in Dublin, but here we are locked down trying to avoid the COVID pandemic. A truly awful and unforgettable period, and our prayers go out to all those impacted who've suffered the loss of loved ones and for those of you who've lost their jobs, of course. We're going to hear about IBA's January market update webinar, and I'm joined today by Stuart Hatcher and Mike Yeomans to deliver that update. Both Stuart and Mike hold the ISTAT Senior Appraiser accreditation. A quick reminder about the range of services that we provide to support the industry. We've been doing that now for 33 years, from valuations, technical and asset management, advisory and data and analytics through our Insight IQ platform. In particular, I do want to mention Insight IQ. It's our one-stop shop aviation intelligence platform, combining speed, visual analytics and intuitive navigation. Our data products have come a long way from the launch of our original IBA IQ of fleet and values data. We continue to innovate and combine more data sources, analysis and insight with technology to provide clarity and solutions to meet your company's ambitions. We've recently added more macroeconomic data and events, historical values, and we'll soon be launching our carbon emission model. More news about that later. So we've almost, I think, 40 slides or so to get through today. That equates to around 45 minutes, and we'll provide at least 15 minutes to address your questions. We have had many questions sent to us already. Some of those responses have been built into the slide deck that you'll see. Thanks for those questions. We will be taking more questions during the webinar, so please do ping them over to us via the questions link on your control panel, and we'll look to address them where we can. It's possible we may extend this session if we get lots of questions from you. If you need to leave after the hour, you will be able to catch up with the on-demand recording at a later date. We should have this presentation and the recording available sometime tomorrow. We have a few polling questions to provide you with an opportunity to share your views, and those questions aren't necessarily new. We've actually asked them before, and we'll compare the opinion from the previous webinars with your current ones to gauge sentiment. So we've over 1,500 people. I think the last count was 1,556. It looks like we've got about 200 airline delegates. The balance is split between leasing and finance community, and the rest being OEM, MRO, law firms, and a few accounting and audit professionals. So now to the main deck. Over to you, Stu.
Cheers, Phil. Okay, so starting with the first slide, I will cover the significant market drivers, plus touch on other areas that will shape the next stage of the crisis and look towards the recovery. First, let's start with GDP. There have been many forecasts presented over the course of the year, starting last year, obviously, with the conservative outlook provided at the back end of 2019, that indicated that 2020 was likely to be a year in which we would say a general economic slowdown was more likely, not necessarily a recession though. Output was expected to fall, although stay positive. In the advanced economies, with slightly diminished growth story for the emerging markets, particularly. Once it became apparent that 2020 was turning into one of those situations that economists only really dream about or nightmares about and postulating, new forecasts were published to indicate the year would turn incredibly negative. Really it seems like a long time ago now, but certainly roller coaster ride is probably an apt description of how the year eventually turned out. By the middle of last year, indications showed that GDP would be approaching a number between -5% and 6%, China at 0, and much of the rest of the world struggling in the mid to high single negative digits. Once we started to see quarantine rules subside in July and August and businesses began to reopen, forecasts were raised in response. But that really wasn't until we saw that in October. Even before the restrictions were lifting, we had already seen a recovery of trading goods despite the trading services being effectively wiped out. Commodity pricing, except oil, recovered, and some semblance of normal order felt almost believable. Sure, we weren't traveling, but for many of us it was nice to spend some time with the family. Possibly too much of many of us would not be quite used to that. We had already seen a second wave emerge in China well before other parts of the globe had even felt the brunt of the first wave, allowing us to take a view on what the pandemic might look like. In summing up 2020 in GDP terms, the initial gloomiest outlook of -5 to 6% moved to around -4.3. In the advanced economies, that would average around -5.4, US at the top of that, -3.6, and the UK trending horribly at -11, partially because it had been hit so hard with the pandemic, but also because our economy is also so linked to services in there too. And also Brexit, of course, was still an unknown at that point. For the emerging markets, China was readjusted to +2, the only real one on there that was a positive, with India feeling the brunt in the emerging markets with a heavy impact of the virus, but also a huge drop in service demand. Now, turning towards 2021 and beyond, naturally, as one would expect, GDP is estimated to show signs of recovery across the board. For many, this is around 4%, with China at close to 8%. In true V-shaped style, the initial outlook for the UK was as high as 5 after such a low drop, a heavy drop, but that was soon hampered by lockdown Christmas period, killing what was left of the service industry, although not before many managed to get out of the country for a winter break. Now, that leads me on to the shape of the recovery. And so from an early perspective, a V-shaped recovery was put to one side, and the market were looking back at prior localized outbreaks for answers. A U-shaped view seemed most logical, as it relied upon changing our habits since every country tackled the pandemic in their own way. If one country appeared to have it sorted, any opening of restrictions would simply let it back once in again. So once we saw domestic traffic recover in China, an adaptation of the V and the U-shaped recovery seemed very probable, although we can safely say that it wouldn't apply outside of Asia or particularly China itself. So everyone would be different. Every economy will experience this in their own, unique way. Some markets will follow a V, others will adapt into a V and a U, and then there is the emergence of the K-shaped recovery, which sounds crazy but very possible when you look at countries like the UK that rely so heavily on services and trading goods. While one is continuing to collapse, the other is reaching record growth levels. There is a strong probability, although to a less extent, to many advanced economies. So we may see that repeat. For the emerging markets, the rising trade of goods certainly helps manufacturing. Now the UK has entered its third lockdown, so Goldman Sachs indicated the UK may feel a double dip, so something going back to the 1970s. But regardless of the shape, there are some traits that have reverberated through many economies during these times, although to different degrees. In an attempt to stave off financial collapse, unprecedented government support was provided within the advanced economies to prevent a surge in unemployment and guaranteeing way for that financial crisis. Without it, default rates would have reached unprecedented levels already, and we would find ourselves in a full-blown global depression. Many airlines were kept afloat, as were countless businesses that were unable to adapt to a lockdown life. The problem, of course, with government support is that it creates a mountain of debt, which eventually needs to be recovered somewhere. However, removing support too early and any growth will be crushed. That aside, unemployment has risen, poverty levels have risen substantially too, wiping out much of that headway made in the past decade. So as we look to the recovery, which is expected to start this year, governments must ease back gently until growth takes hold across a much wider sector base. Unemployment will rise as defaults increase, which will put a strain on bank balance sheets as our changing habits partially take hold, and we have to be prepared for that. We have fewer options regarding interest rates, as they will move into negative territory if they go any lower to stave off deflation, but the dollar continues to slide, so reflation has been highlighted as the next possible step. Biden is expected to come forward with a very large stimulus package in the next few days of his administration, but taxation must be kept in check until the recovery is fully underway. Next slide, please, Lucy. So I want to, of course, touch on the vaccine rollout, as this will certainly impact our industry. And we have achieved what was considered to be the impossible, creating a vaccine in record time and mobilizing the largest logistic exercise in history. But of course, it isn't balanced. Of the 10 billion doses pre-ordered, 50% are going to advanced economies who account for just 13% of the population. It is, of course, these 13% that are primary driver for airline traffic. So it will be felt much stronger in economic terms, but will potentially restrict much of what we do for a longer period. Now, looking to the map of the world there, the red areas are those countries that have ordered enough vaccine to cover more than their population. And in fact, Canada and the UK have hedged their bets by so much by ordering to cover over 300% of their populations. Australia and New Zealand over 200%, while the rest of the red zones are between 100 and 200%. The US is around 150. The blue zones are countries that have ordered somewhere between 50 and 99%, while the remaining areas are all below 50, with many of them being only the 5%, and aided purely by group initiatives and corporations. Ultimately, as effective testing and tracking has failed to hold back the virus more than a few months, we must rely more heavily on the positive impact on the vaccine, but that should not stop a large return of the market if a system or rapid testing and response measure was in place. You know, for many of us, there are no or fewer restrictions in place that many of us will be happy to travel. So, you know, the vaccine is principally there to protect the most vulnerable, but as vaccinated people can still carry and transmit the virus without that rapid testing and tracking in place. Vaccination may not simply need only to work in our own country. We need to be much wider. Though the best will in the world, successfully vaccinating the advanced economies will take up much of 2021. But once the vulnerable have been treated and deaths subside, governments will be faced with pressure to open the borders with those in a similar position to prevent debt getting too much out of our hands. So I expect to see both domestic and inter-regional traffic showing growth, with inter-regional traffic remaining limited. So I must stress that the latest variant of the virus will add a level of further urgency to that matter. And of course, this is a natural part of a virus's life cycle to become more contagious and sacrificing its potency in the process, but the governments and the media generally downplay that part. You know, we must consider that if this recurs readily as the flu, such that we have a COVID season, you know, this is something we have no choice but to accept and get on with. Now, with that, I will pass over to Phil for our polling question.
Yeah, thanks, Stu. Question for you is, you know, given the progress on the vaccine rollout, are you confident that vaccines will get people back flying? Cautious, 2021 will still be slow, 2022 will see a recovery. Concerned, vaccines are only the start, recession will hit. Very cautious, better testing would help the industry more. So let's see what your preference is on those ones, please. And then we'll have a quick look at those results and then see how that compares to last year. We didn't ask exactly the same question last time, but it looks like the vast majority are in that cautious zone, and I suppose that's reasonable. I think we should have the slide that will show us how that compared to last year. Okay, so it's a slightly different question, but actually, I suppose, you know, we were still thinking about being cautious, recovery in 2022. So it appears as if there's been no major change. I mean, this question, I think we have November 2020. So there was a lot of talk about the vaccine rollout, but there's obviously been the huge second wave that we've seen, particularly over here in the UK, and other strains, Brazilian and South African strains. So still some pressure on us. Okay, back to you, Stu.
All right, cheers. So just briefly touching on oil, you know, clearly with the demand being wiped out in many sectors, oil demand will be, you know, being hit pretty hard. It's been predicted that approximately 7 to 9% of oil demand has been wiped out. Now, recounting back to what I said previously, a slowdown in 2020 was expected to affect oil demand, but obviously not to this level. Consequently, you know, without production cuts, pricing would only go one way. You know, production was cut a month or two into the pandemic, but of course it was a bit late then, and we saw some big drops in those numbers. And really, you know, Saudi Arabia made a drop then, and then they've subsequently announced they're making another drop next month, another 10%, which is another million barrels a day, and the market's responding very well. So we've actually started to get that ticking up. I'm talking from an oil trading perspective rather than from an airline perspective. As always, oil economists predict that pricing will stay largely the same, albeit with an upward tick at around 60, which we're already close to, or sitting over actually for Brent. And that seems sensible given the increased demand expected. Now, on the emission side, of course, over 2020, emissions were down an estimated of 46.6% on 2019, with costs being down a whopping 71%. So there is a silver lining in there somewhere, and we'll come to that later. So next slide, please. So an area that was responsible for much of the pain 2 years ago was currency. For what seems like an age, the dollar has been strengthening to build, an airline market whereby we've seen it, some achieving record profits, those dollar denominated, whilst those not dollar denominated being forced out and really into the low growth numbers. Since mid 2020, the dollar has been sliding, something Trump has been after for some time, as it certainly encourages that growth. Now, this has seen somewhat of a surge for the euro, which the ECB would want to temper at this stage. Weakening currency may not sound healthy, but it is the potential first step in the recovery process. It can trigger reflation that will turn away any deflationary effects and boost trade. Aside from the global effects of dollar strength, airline operating costs will be praying for there'll be many praying for low oil and a weaker dollar as costs can quickly get out of hand. But looking at the chart, no surprises really that the same four that were trailing last year and the last couple of years with Argentina, Brazil, and Turkey particularly are still there. Next slide, please. So turning towards the traffic now, we've all seen the fall in RPKs over the past 8 to 10 months and dream for a time when it would return. Well, it looks like there is some way to go still to get back to those 2019 levels across all sectors. So we must be carefully consider the focus our energy to provide the best chance of success. Whether we assume a vaccine is fully deployed or not can cause a great deal of speculation. Some markets simply to look to what restrictions are telling them. When the UK government announced that the UAE would be open and off that list, we saw an absolute resurgence of bookings, in fact, exceeding the prior year, such that there was pent-up demand was so high. We can therefore postulate that given a reasonable amount of time for large chunks of the population of Europe and North America to be vaccinated, such that all vulnerable people have been treated, the government may take this opportunity to remove restrictions and wean people back into a more hectic lifestyle. We would therefore consider that based on the current situation that Europe and North America will exhibit the strongest intra-regional recovery in airline traffic. I would also include China in that, but they are already well on that path anyway. Now, briefly touching on the cargo market, the impressive yield growth we are seeing in the market originates from a lack of capacity growth. Overall cargo demand has been lower than the prior year, but the shift from belly to preighters and freighters had a massive effect. But of course, that's not long lasting. If overall market recovery ensues, then we may miss another collapse of freighter demand. So, positive news from that side. The next slide, please. So turning to the 7 regions covered, and briefly, all are exhibiting some form of growth. Some are starting from an extremely low base, of course. North America and Europe are expected to show the largest growths, principally interregional traffic. And we also expect Australasia and the islands to remain collectively isolated too, as well as China, for a period still to come. Now, capacity will rise across the board, and it's not difficult for it to do so. But mostly more fuel-efficient narrow-body assets, except where volumes and distance really do become a problem. So whilst the top end will experience a 50 to 60% growth in RPK, that's the US and Europe, the rest will settle for a 30% increase on much of that. And of course, within China, then there isn't so much headroom for that, and capacity will increase between 20 to 30%. Across that board, and we'll look a little bit at the storage trends later. Next slide, please. So I'm going to briefly look at some utilization trends, only briefly, that have occurred over the last 12 months. We have used these some in previous market updates, just as continuing to update, which we've taken straight from our platform. I could go into any entry level of detail really in terms of specific routes, operators, aircraft types, ownership types, but I'll keep it pretty high level for now. The difference in what I've done previously is I've also added the load factors in as well. So it does give you another viewpoint as to how that's been operating. In the first chart, we can see the variance of total passenger flights over the last 12 months, which did experience some strong resurgence as we approached that summer season. So we saw that from July. and new cases started to reduce. Many people managed to get a summer holiday, although the inability to predict whether a restriction would come into effect hampered any real resurgence globally. And looking at it from the load factor side, you can see there we've gone from sub 40% to over 60%, with a slight dip, and we haven't quite got the data yet for December. So cargo traffic, on the other hand, remained pretty firm, albeit the number of flights is only 5% of the passenger traffic, but continually good progress still continued to be made there. And over to Phil for the next polling question.
Yeah, thanks, Stu. So just sticking on this freighter market, we'd like you to consider this one. Which is more likely? The uptick in freighter demand will, option one, continue due to lack of passenger belly capacity, continue beyond the return to a new normal, or not continue once passenger traffic returns to 2019 levels. Let's see what your preference is on those fairly limited choices, but let's see how you feel at the moment about the freighter market. Okay, I was going to say a pretty even spread, but obviously the continue due to lack of passenger belly capacity and continuing beyond return sort of gets the majority, but that's still a fairly significant number of you looking that it won't continue once we get passenger traffic back to 2019. Can we have a look at what the sentiment was the last time we pushed this out? That's very simple. That is amazing. So all I can say is that you've got very good memories and you remember what you voted for last time. That's, well, almost uncanny, but that's the purpose of comparing it, really. That's incredible. Thank you. Is it back to you, Stu?
Yeah,
on the
it is.
Russia-China. Thank you.
Yeah, so looking at the Chinese and the Russian market, so hard to imagine, but there are two markets that have exhibited growth, and we looked at this a couple of months ago. There have been a few changes since then. When we looked at this back using data from just the summer months, domestic China and Russia particularly, so Russia has also exhibited positive RPKs too as well, which quite surprising really. Load factors in the 80s, before dropping again as the second wave hit, and of course the northern hemisphere winter started to approach. So despite the Chinese capacity exceeding flat from the start of the year before, RPKs were nearly still 20% down year on year in August. Now China's traffic may be up, but the new strain doing the rounds is something governments want to avoid. And then of course yesterday I saw news about another variant that's come out. So there is still quite a lot of chopping and changing going on, and governments will want to restrict some movements and travel over this period. And so Chinese New Year celebrations may well become a lot more localized than what they were expecting. So next slide, please. So moving to the high volume markets, just an update really on these ones. And I've chosen North America, Europe, and Asia Pac, including China. And whilst their flight mix is starkly different for Europe, capacity has managed to reach around 50% of January levels. Although with load factors being so low, RPKs are still close to 70% down. Within Europe, many people managed to get away for the summer, plenty of traffic with UK, Germany, Spain, Italy, France, Greece. But sudden changes in quarantine laws really put that back, and we've seen a massive drop of that. And actually next time round, I think I'll probably look at the traffic just between Switzerland and the UK and UAE and the UK to see all the people legging it for a winter break. It's certainly been illustrated that same way. We've seen that with the Russian side. So certainly, an uptick in the Asia Pac in there, but obviously governed by China from that point of view, whereas North America still continues to be relatively flat. Next slide, please. So looking at the smaller markets, the impact of the virus on Latin America, Middle East, and Africa has been particularly hard. And you'll see that there's a very similar shape between many of these three. Domestic movements, had led the way proportionally, but there have been very few southern movements, unlike we've seen for, say, Europe. And compared to the other two, the Middle East generally has the backing of the governments, but low oil pricing will heavily impact most of the regional economies there. But certainly the support we've seen within Latin America and Africa has been pretty dire, and certainly concerns there. But interestingly, when you look at the load factors within Latin America, you know, with they're operating certainly denser flights than we're seeing anywhere else, where we're seeing load factors getting above the 70% now. Whereas when you look at, say, the Middle East, they're really down only at a third of that. So you know, a stark difference in the way it's operating. Next slide, please. So looking at that storage, you know, where we will be at the end of 2021. Now, looking at the chart, you can almost visualize the VU-shaped recovery happening. But this looks much more like an L shape to me. You know, it's let's be frank, there really isn't much space left to store aircraft. The good stuff that could be fit to a route structure came back for the start of July and has remained pretty much in there since. So it will take another build up to the 2021 season before we really see another significant drop, which we expect to keep steady until the end of the year. Now, we do expect some storage obviously to rise while we have some more lockdown measures going in. You know, it's still far larger than where we were starting in January when we look at, say, the end of 2021. But, you know, a lot better than where we have seen April last year. You know, there are no surprises. The fuel efficiency will be targeted as pricing and lease rates are so far south that takers can be pretty selective. That is, except for those aircraft they need to hand back and can't afford to compensate for. That's very important. If the government is backing them, then cries for help will certainly fall on deaf ears if they think they're going to get away with any longer handouts. You know, aircraft on long contracts, decent freighters, and the best large twins will continue to be the top of the list in terms of that, but obviously weighted towards the ones coming back will be towards the narrow bodies. Next slide, please. So looking at the recent failures administration cases, you know, I've gone through this many times, but just to recap, we measure here the number of failures, all those who go into administration in orange, and the number of aircraft involved in red, overlaid with Brent pricing. Now, the chart principally identifies where the cost where headwinds are, traditionally a factor of volatile oil pricing and more recently currency, relating to airline failure. You know, for 2020, it's been down to exposure of fixed costs and therefore comes down to survival using cash reserve, payment holidays and government aid until the market starts moving again. As the crisis persists, then the ability to pay anything back becomes more remote, and so administration offers a way through to restructure. To sum up the year, we got past the 1500 point, not bad from the prediction of 1400 I gave back in April last year. Stripping out the operators of small aircraft, we had about 33 failures and 11 seeking protection on top of that, which hold the bulk of the aircraft involved. As expected, we went from what was the worst year on record in 2019 to without doubt the absolute worst year on record in 2020. But 2021, of course, is when we would expect much of the government support to be removed at some point. And the large number that still undergo restructuring are the ones to watch, as there will be some continued fallout to exist. The year would have been a lot worse if it hadn't been for unprecedented government support packages that far exceeded $100 billion. However, this support is not even, and airlines that should have failed to ease that market strain continue to limber on. You know, we must also consider that with every failure, the others in the space will receive that demand boost. So next slide, please. So the timeline for the failure activity is shown here, with Flybe being that first decent sized carrier to go. That was at the beginning of last year, although we may see that one come back, so it's going to go almost full circle, ending with Cathay Dragon's failure and Norwegian's partial seeking of protection, and subsequently now saying that they're actually going to be getting out of long-haul operations. So that is still one to watch. What is clear that is after July, the panic eased somewhat, uncertainty made way for adapting to a new reality, and many airlines managed to adapt. Clearly, initial bailout packages are running dry now, as payment holidays such that lessors will have to continue to make the difficult decisions on how to react to their airline customers. As already mentioned, labour costs need to come down by about 40% to readdress the situation, something more challenging for operators to deal with compared to capacity reductions and raising finance. So on the restructuring list, I've also added Thai on there as well. Not really a failure, not a failure, but it going through a restructuring as well. So it's always worth a note mention there. Next slide, please. So finally, my final one, just touching on the latest government support. I won't go through this in detail, but most regions continue to prop up household names. Renationalizing could be a word for it in many cases, which will undoubtedly lead to expansion problems down the road, especially when up against a ruthless low-cost carrier. Now, outside of Europe, South Africa continues to cling on, but support is still there. Latin America has seen some rather woeful attempts at support, and this practice continues, such we don't expect the battle to end just yet. Whilst north of the border has seen a sterling support of its airline industry. However, it illustrates that years of solid profits don't quite detract from the fact that they're still too heavy. Asia Pacific were already holding on to some weak airlines before the crisis, and there hasn't been a lot of support so far. So how are they keeping their head above the water is a reason why many of them are on our watch list. So, and finally, touching on the Middle East, government control is already pretty high anyway, so it is kind of what I would expect. So over to you.
Thank you. Yeah, thank you, Stu. That was very comprehensive. We're about halfway through, so I'll be swift here. In terms of the environment and sustainability, I think the last year has seen a significant number of inquiries. So whilst I suppose being a little bit cynical, I thought maybe the environment and sustainability might go onto the back burner, excuse the pun, but clearly that's not the case. This slide was actually from the Boeing Capital deck, but it's actually Bloomberg data. It's for those of you in the finance community, you'll be all over this, of course, because the ESG aspects are probably significant areas that you need to cover off in various proposals. So the next slide is really showing where we're coming from here. Last year, we published our aviation and the environment report, just about this was the anniversary, I think. And then we went on to present at the ISTAT event in Austin, late February, early March. And we've had significant inquiries from a lot of the new investors as well as established ones over that report being updated. That is about to be published in the next week or so. We're doing an update on regulations and compliance. There's also a look at some of the green financing initiatives that have been published over the last year, some sustainability loans, etc., to various airlines, and also the OEM developments, because obviously this is attracting a lot of research and investment from the OEM. So we've seen sort of Airbus and Boeing pushing out their views of 2035 and beyond. So what does that mean for IBA, and what does that mean for yourselves? We are going to launch the Insight IQ CO2 emissions calculator. That is in the final stage of development, so you'll see that very shortly. We do know that there are some other calculators out there. We do think our USP is that this is going to be on a per aircraft, per route, or per flight basis. So it's going to be very granular, so you can build up the portfolio emissions relatively easy based on your own portfolio or investment criteria. We're also going to be adjusting our airline score index. We will have an emission rating based on a particular airline's policy and processes with regards to emissions. And we'll be adding an aircraft evaluation rating, so categorizing aircraft based on their efficiency. That was a quick one for me. I think it's over to Mike now, please, with the next section. Okay,
that's great. Thanks very much, Phil. Thank you. Hello, everyone. I'm going to start by looking through a couple of slides, looking at the OEM picture, seeing what's happening there. Then we'll move through the secondary market, have a look at what's happening in the secondary market, and then some updates on the values and lease rate side. So starting off with the OEMs, this is a summary of the orders and cancellations from 2020. We have not got all of the final numbers in through the end of the year, numbers from the OEMs, from Airbus and Boeing. So there may be some final adjustments based on those numbers there, but not going to be too much change to this picture. You can see clearly in terms of the net orders that we saw last year, Airbus leading there with some cancellations, most of those orders really in the earlier part of the year. We did see Sukhoi and Comac both with positive net order positions, Embraer and ATR sort of staying similar in the middle ground there. But as we move to the right of the chart, you can see Boeing suffered most cancellations and therefore the weakest net order position through the year, around 400 negative. And that's primarily driven by the MAX program and the delays there, which saw a large number of cancellations through some of the lessors, less so perhaps through some of the airlines. So when you look on the right-hand side of the chart there, you can see how the backlog shapes up between the different OEMs. This includes all the narrow body, wide body, all the market segments there. So Airbus with just over half of the backlog, Boeing with just over a third, and the remaining led by COMAC shared amongst the remaining OEMs there. If you look at the narrow body program, Airbus A320neo, 737 MAX, there's around a 60-40 split there. If you start to factor in the current or the installed fleet and the A220 program, it starts to move more towards a 65-35 split on the narrow body programs at least. We can move to the next slide, please. We'll have a look at the deliveries that we saw last year. With the MAX not delivering for much of the year, this is led largely by the A320neo family. We saw a delivery rate, production rate around rate 40, which is around 38 aircraft per month. So you can see that the share of the deliveries heavily stacked in Airbus favour there, although at a lower level obviously than previous years, accounting for nearly 3/4 of the deliveries last year. That's shown on the left-hand side. We did see the MAX start coming back. We have a slide on that in a moment. So there's around 27 aircraft delivered there. A350, 787, fairly similar pegging. We've seen production rates declining on those aircraft, and we expect that to continue into 2021, which we'll have a look at in a moment. As you can see, unsurprisingly, production rates and delivery rates have declined significantly. On the regional side, turboprops, there was less than 30 deliveries, so a big drop down compared to previous years there. As well on the regional jets, some significant declines. There was a pickup later in the year where Embraer delivered, I think it was around 30 odd aircraft into the US market. That was some Embraer 175s. It still has on backlog, but the E2s were dramatically reduced. If we can move on the next slide, please, we'll have a look at our expectations for 2021. So this again is going to be dominated by narrow bodies, unsurprisingly, given the sizes of the backlogs. The numbers on the top left here, this is just looking at narrow bodies. You can see A320neo family, we expect to lead the deliveries this year. That assumes a broadly similar production and delivery rate to what we saw in 2020. We're aware that there's been some readiness for an increase, but we're expecting it to stay at similar levels. Obviously, we have the MAX delivering now. The numbers there include approximately half of the aircraft that have been built and yet to be delivered. And as announced by Boeing, that's their intention to deliver those aircraft, half of those aircraft, should I say, during this year, and also filtering in aircraft from production, which is resuming now. So we expect to see that at or maybe below 30 aircraft per month. That's the numbers that we've factored in here. Smaller numbers of A220s, obviously smaller backlog, and the last few A320ceo family aircraft are expected to be delivered this year as well. As we move to the right there, you can see the wide body delivery forecast. Again, 787 and A350 staying at similar rates, around rate 5 through this year. There are some delays to the 787 deliveries based on additional requirements for inspections that have been well reported in the market. So we may see some delays there, but we're expecting still to see around rate 5. As you look further down the bars there, the 777, that's going to be dominated by freighters. You've heard from Stu there the strength of the freight market and demand for freighters. So that will support a lot of those Boeing wide body deliveries. You can see the 767, that's going to be all freighters, the 74 as well. There's been a couple of orders that we've heard recently for the 74, and that will be some of the remaining backlog there. The A330neo family, we expect to reduce to around rate 2. If you look now down the bottom of the chart, you can see the turboprops on the left there, expecting ATR deliveries to pick up this year. The Dash 8 backlog is dwindling, so we expect that to be significantly lower than where we see ATR's deliveries through 2021. And as we look at the regional jets, do expect to see a pickup again in terms of that's going to be mostly on the 190, 105, that's going to be the E2 family. On the E170, 175, that's exclusively going to be 175s, E1s for the US market. We also expect to see COMAC pushing to increase the production rate and deliveries on their ARJ21 with similar sort of levels really to what we were seeing last year. So on the far right hand side of the chart, you can see how we expect the deliveries to be distributed amongst the OEMs, with Airbus leading, Boeing in second there, and Embraer and ATR close third and fourth. If we can move to the next slide, please, we will have a look at the MAX, which is now back in service. 27 aircraft, as I mentioned, delivered to customers in December. We have made some softening adjustments to our value and lease rate opinions of the MAX 8 aircraft. We already had a softened market value prior to the grounding, prior to the crisis, so we've not made a massive reduction compared to that, but it is really aligning with soft market value, as you can see on the right-hand side of the chart, on the right-hand side of the slide, sorry, on the chart with the orange bars there. We're expecting to see some lease rate pressure continuing there. We were seeing that before the pandemic, before the grounding, and that's what we expect to see going forward with this year at least. The maintenance clocks, we're zeroing those on the aircraft. The aircraft that have been built and yet to be delivered, we've been assured by Boeing that those will be delivered as new, fresh in terms of maintenance. So that's something that you will see in IBA's values, be they desktop or online reports. In terms of the return to service globally and deliveries resuming and the volumes thereof, that's going to be guided by the recertification and which jurisdictions bring the aircraft back online. Obviously, we've seen that from the FAA. EASA, we're expecting that to be lifted by the end of this month. That's the reports say there. However, China remains grounded, and we don't have a particular timeline for recertification there. Obviously, that's a key market for the aircraft, so we're expecting some delays there, and that really feeds into the picture that you saw with lower deliveries compared to the A320neo in the previous slides. In terms of passengers accepting the aircraft and their willingness to fly, we have seen some somewhat mixed messages in terms of some polls suggesting negative sentiment, but the operators that have flown passengers so far, GOL and American, they've shown no obvious concerns. Though we have noted that American has offered some flexibility around bookings, but we haven't really seen that they've had to use that yet in terms of moving passengers onto different equipment. So it's early days, but from what we can see so far, it's looking positive. If we can move on to the next slide. So just wanted to talk through now some of the trading levels and what we saw last year and what we're expecting to see in 2021. So sale leasebacks really was leading in terms of 2020 versus 2019. We saw a significant uptick in sale leaseback transactions, airlines trying to raise capital, obviously with the slower levels of flight passenger traffic movements, etc. We expect to see that to continue into this year, particularly with the return of the MAX to the market. That will create opportunities for sale leaseback transactions. Where we saw declines at much lower levels were trades of aircraft with lease attached. We really saw a pause in lessor to lessor trading activity, which caused a lot of that decline. Also, sales off lease were much lower, given the lower pricing expectations in the market and mismatching between buyers and sellers there. That's really what you can see on the left hand of those charts. On the right hand side, you can see we saw a massive uptick in capital market activity, the EETCs. We saw 578 aircraft in transactions there. That is largely supported by a big transaction there with United, around 350 aircraft, which you can see causes that massive jump in the line there. So there is a big transaction in there which skews it slightly, but still a very large uptick. So what do we expect next year? Well, as I say, sale leasebacks expected to continue. We're expecting to see more sales of aircraft with leases attached as we start to perhaps see some more turbulence in the lessor sector, maybe some portfolio sales, maybe some M&A activity. And we may see the return of some ABS transactions. We know that there are some in the making at the moment, so we're expecting to see something around that market returning in this year, in 2021. We can move to the next slide, please. So this is part of our values update. I'm going to just talk through first the narrow bodies, then the wide bodies, then the regional. We're making these changes in our online IQ system. That will be towards the end of this month. So I just wanted to point that out. And these changes that you'll see in terms of a percentage basis is not from the start of the pandemic. This is from our previous valuation update to our current valuation update. So this is sort of 2020 into 2021 changes. Unsurprisingly, you see values are under pressure for most types, narrow bodies included, but there are differences depending on the technology, aircraft type, and the age of the aircraft that you're considering. So the new generation aircraft have held up much more strongly. You can see that from the table on the right-hand side of the slide there. A220, A321neo, we see those as strong sort of recovery aircraft from this pandemic, given their flexibility and capabilities. So we haven't made any specific changes to values since last year when we did make some changes there. Older example of the current generations are where you see deeper cuts and you'll see market value aligning more with soft value. You can see that with the A319, there's had some deeper cuts to market value as well, the A320ceo. The 737NG, we've seen performing comparatively better. The 737-800 particularly performed better than the 320ceo. But as we start to see more MAX aircraft coming into the market over this year, we do expect to see NGs displaced, and that could have some impact on market value. So we'll be watching that closely as we go through 2021. We've also seen further evidence of lease rate softening. We're seeing some extensions and leases being negotiated quite aggressively there. We do have a slide on the lease rates in a few slides' time, so we'll move on and have a look at the values of the wide bodies first. So this is an area, see the commentary that you've heard from Stu on the international markets being much more negatively affected by domestic. So this is where we're seeing a lot of the pressure in terms of value movements. So most aircraft types have featured downgrades to current market value. Unfortunately, a selection of types, we have had to make some adjustments to base value as well. So you'll see that flowing through our update later this month. A330s, you've seen downward revisions there in terms of market values up to 25%, also in terms of base values up to 20% on certain vintages. We were seeing pressure on that aircraft type before we entered the pandemic, so this has really exacerbated that. Storage levels remain high levels of oversupply in the market there. Somewhat of a positive though, however, that is causing us to see more interest in the P2F market for that aircraft. That's both in terms of the 200 and the 300, although the 300 has been the more popular for that P2F market so far. So perhaps creating some opportunities there with values coming down to lower levels. The Boeing 777-300ER, we've seen a number of fleet exits announced for that aircraft type. We were seeing softening in values and lease rates pre-pandemic as well. So we have had to make some downgrades to market value and base value there. Not quite to the extent of the A330, but still up to 13% on the market values and the base values getting close to 20% on some of those earlier vintages, so sort of steepening the depreciation across the different vintages there. Well publicized, the A380 has been one of the biggest casualties of the pandemic. Very high levels of storage, operators moving away from the aircraft. So we have had to make some fairly heavy cuts to market and base values there, almost 50% on some of the vintages, seeing very steep depreciation. That's across market and base values for both those types, for both of those values, sorry. We've also had to make some adjustments to some of the older out of production Airbus A340s, 777s, classics. That's in terms of market and base as well. If we just move on now, we'll have a look at the regional market segment, some of the assets that serve that market. Somewhat more of a positive view, which is always good in these times. So we are expecting, given the domestic travel is expected to return to growth quickest, we're expecting to see more of a recovery in this market. So we have not had to make such significant changes here as some of the other aircraft types as we've seen on the wide bodies. That's not to say these aircraft haven't been affected by the pandemic, obviously they have. It's just we made some quite heavy cuts to values in the last update. So we're still seeing pressure on the Dash 8, the failure of Flybe, a lot of aircraft into the market there, which will take time to clear that oversupply. So we're expecting a longer timeline to recovery for the Dash 8. The E-Jets, we are seeing transactions occurring in the market. We're seeing leases and sale transactions, which we expect to conclude in 2021. And we've seen a couple of large transactions with Alliance Air in Australia acquiring ex-Copa, ex-American aircraft to replace its older fleets there. So we may see some more fleet replacement of older aircraft types using some of those aircraft. CRJ remains somewhat challenged there. It's not proved as popular with the US markets as the E-Jets, which seems to be where the more of the demand is in terms of this market. Now, ATR, we have seen oversupply, but not to the extent of the Dash 8. So we're expecting to see a quicker recovery for the ATRs, particularly the newer 600 variants compared to the Dash 8s, given the levels of supply in the market. But overall, the sort of fundamental roles and missions that these aircraft fill and the markets that they serve should see them recover as we start to see markets recover through into next year. Have the next slide, please. Okay, just quickly looking at the lease returns now. This is what we saw last year. So we saw around 1,100 aircraft returning off lease. That's perhaps a little bit fewer than we would have expected. Some difficulties in actually carrying out the lease returns, difficulties based around the travel restrictions, etc. And given the weaker demand, we've seen negotiations and lessors offering concessions and assistance to their lessees to try and keep those aircraft in with those carriers. We've seen deferrals, powered by the hour type arrangements there, and some restructurings. So as we look to this year and what we expect, well, I think we will see an uptick in terms of the number of redeliveries. You see our orange bar on the right hand side of the screen there, that would be around 12,500 lease returns. That's based on sense for this year. It doesn't factor in any extensions or indeed any airline failures. So if we see airlines fail, or if we basically airline failures, we may see that number shoot up, which is why we've got the arrow pointing upwards on that bar there. If we go to the next slide, please. So as promised, this is just an update on lease rates. We saw fewer new leases in 2020. It's a little over half of what we saw in 2019, and that really affected all of the markets. We're seeing obviously a weaker demand picture, airlines with oversupply in the market, so fewer opportunities, fewer demand for airlines to take new aircraft on lease. That has resulted in us downgrading lease rates across a number of aircraft types. You can see the table on the right-hand side of the screen there shows you a selection across the wide body, narrow body, turboprop, and regional jets. So just giving a typical market lease rate range for the various ages, which would be representative of those aircraft types. So you can see some downgrades, fairly significant downgrades on the A330. We've seen pressure for a while there, so around a 15% reduction there. On the 350 and 787, we're in a position where we may start to see some aircraft come out of carriers there, so you might see some pressure to get some of those aircraft placed, though that might take some time. The Dash A rates have softened further there, again reflecting the oversupplied conditions. So just to give you a little taste of the changes that we're making in our update at the end of the month. We can move on to the next slide, please. I just wanted to summarize some of what's going on in the engine market, which I'll do quite quickly so we can move on to questions. The trading volumes remain pretty low, similarly to this sort of off-lease trading mentioned in the aircraft market, matching the expectations of buyers and sellers, sometimes difficult there. We have seen sale and leaseback activity continuing, as previously mentioned. We are also seeing some lessors avoiding write-downs by parting out internally rather than selling at a loss. Now that can be a slower means of realizing value, but more profitable in the long term. And we have seen a lot more demand from our customers asking us to look more closely at the values of assets in their piece parts, looking at values of engines, doing sort of more thorough tip-to-tail analyses. So that's something we have certainly seen more of a requirement for during the pandemic. The freighter market remains resilient. The engine types which feed that market, we'd be looking at the CF6, Pratt & Whitney 4000, 2000. So we're seeing more positive performance there, should I say, because of the strength of the freight market. Shop visits continue to see limited demand, and we'll look at that on the next slide a little bit more closely. So what's that driving in terms of the results? Well, we're seeing heavily discounts in terms of distressed sales, less discounts on some of the newer engines. We are seeing a big impact on the short-term lease rates, down, as you can see there, 30 to 50%. Often the maintenance burden pushing over onto the lessor, which we typically see in some of those weaker conditions. We're seeing no minimums on some of those deals, and we're also seeing effects on the credit quality in terms of the operators that we're looking at in terms of some of those leases. On the lease rate factor side, much like what we're seeing in the aircraft leasing side, we have seen some improvement in terms of LRFs, but from a low base. If we can move on to the last slide on this engine market, we'll just have a look at, it's not the last slide, sorry, it's the penultimate slide. So similar to the aircraft market, wide-body seen a more significant impact, 20 to 30% on some of those engines there, the G9Ts to Trent. When we say value impact ISTAT, we're talking about an ISTAT defined market value. If you have to dispose of the assets in short order, that would look more like a distressed transaction, and we'd be looking at a further discount. Narrow body, similarly to the aircraft markets, less of an impact, with 10 to 15% across those current generation commonly traded types. We can skip to the last slide, please. So this is really looking at the impact on MRO demand. You can see the shaded area in the back is our pre-COVID view on number of shop visits going out to 2030. The dotted lines where we would have expected the 2020 level, just flatlining that across. And we're offering sort of three scenarios potentially how we might see that demand evolve over the period. So a more optimistic, a sort of middle base case, and a less optimistic there in terms of how we see the shop visit demand return. So we're looking at the return, obviously, of the fleet flying. We're looking at the MRO capacity as well in terms of when that returns and its ability to service that. But as we go forward, the longer this pandemic lasts and the sort of more negative scenario you look at there, the more chance there is some engines will not make it through their subsequent shop visit. When we're looking at engines that might fall into those categories, we're looking at some of the wide body, older types and more out of favor types that we discussed earlier on in the presentation. So with that, I will pass you, I think, back over to Phil to wrap up with some of our key takeaways. Thanks.
Yeah, thanks. And just to let you all know, we are going to continue this session for another 15 minutes to run through some of your questions. We've had some really good ones. So if you can stay with us, that would be really good. Or you can catch up as this is being recorded anyway. But we still have 500 of you still on this session. So yeah, just to run through these, the vaccine news is positive, still a long way to go. I think as far as the some of the uptick, we are expecting to see some rebound in the domestic and intra-regional travel. I think the E and ESG does still will still become an increasingly increased area of attention for lessors and investors. I think we'll see some airline fleets emerging younger and more simplified, and this will have an effect on values and lease rates of some of the older families, as Mike has touched on. We do expect the 737 MAX returns to start possibly increasing as we head towards the northern hemisphere summer. And as far as these new generation narrow bodies, they appear to be fairly resilient. Regional aircraft look like they're going to set to recover once we get the domestic and inter-regional travel going. Wide bodies still remain challenged. And I think what I would like to go back to some of the questions we've had now. Stu, we've had a lot of questions about the 2021 lease returns and options and what that market's looking like. Have you got something that's a bit more granular that you can share? I think you're still on mute, Stu.
So yeah, if Lucy passes me the comms, then I can have a look. So presumably you can see the screen of IQ. So if I look over to the events for we will look. Let's go. Let's show the forecast. So if we look at lease end events, so if I sort of spread out the next number of years, there's sort of 2021. Narrow bodies taking quite a big leap over where it was in 2020. Some of the, I mean, of course, some of these are contracted, scheduled. Some of these are estimated as well. We have a much smaller number of turboprops and regionals. They are harder to track, and with a decent number there of wide bodies are in there too. But if I look specifically, say, at just sort of 2021, and I break that down to its snapshot, then sort of look at just the leases and the lease ends, you get a view there as to who the lessors are. So, certainly AerCap pretty high on that list for 118, GCAS around 100. Then you've got the sort of the next tier down, which is the sort of the Avalons, SMBCs, etc. All in that sort of 30s, and then some smaller ones there as well, down to sort of the teens. And then if I look at, say, the operators that they're coming from, particularly, I think Indigo is high on that list. Yeah, so Indigo, they've got quite a lot of NEOs that are coming through on the pipeline. United, American, no surprises there. Air France have got a lot of scheduled ones, but Air France is where we would typically expect most of the extensions to happen. They are typically quite strong there on extensions. EasyJet got quite a few coming back. They've had some movements obviously with the debt situation quite recently as well. And when you look at, say, the aircraft types, no surprises really. The NGs and the CEOs, they're very high up on that list. When we start looking at, say, some of the unscheduled returns, potential ones, then we're starting looking, say, Avianca or LATAM or we've obviously got Norwegian 787s that potentially could be coming back now. They start adding a different dimension. This will be the highest number in history that we've already achieved to that point, and the MRO space can't really handle that either. So we could see a lot of dumping. We could see a lot of that going on. But I would say that obviously some of these aircraft are going to be hot to trot and extending, because a lot of these ones that are due to come back, we just don't know yet how many of these that are scheduled to come back in 2021 have already been contracted for beyond that, because the payment, they've pushed out their deliveries and they want to just suspend that process and wait for the recovery and not be faced with a huge debt mountain with a new aircraft. And they've negotiated a decent lease with an extension on the end. So we expect that 1261 to come down from that aspect, but also go up on the other aspect in terms of unscheduled. Yeah, it's going to be an interesting one. It's quite hard to predict. That's one of the reasons why we haven't gone so granular with some of the forecasts we've done for lease ends just yet. Yeah, so over to take the screen back, Lucy.
That was really useful, Stu, and does show the power of Insight IQ. Thanks for that. We've had a question which is from one of our ex-colleagues. Today's Financial Times has an interesting article on the future of business air travel and suggests that whilst it will recover, many companies will seek to reduce it based on the COVID experience, ESG considerations and cost saving. What are IBA's views? Have you got a view on that, Stu? I mean, business travel, I think we're all going to be really revisiting how we work in the future, aren't we?
Yeah, I mean, I remember I was on a panel in New York with the rating agencies, and they were quite bullish that no, it's all very fine. It's, in a very American perspective, that business travel was going to recover fairly quickly, and this was back in October. From the discussions I've had with people, and certainly in Europe, apart from obviously the conferences and certain deals and face-to-face stuff, as a world, we have become more adept at working from, less from traveling and working more digitally. There are certainly things we can't do. It's very hard to have a proper discussion online if you're having to make a decision. It's very hard to do teamwork when you're trying to do, sort of problem solving or some development or design. We've certainly found problems with that. Conferences, you can't do it. You just don't get the networking. But I would say that there's going to be a significant percentage that will disappear, and it's habit forming. Habit forming. You only need a period of time to make a habit, and we've done it. We'll have done it for a year by the time we can get within 2 months. So I suspect that certainly within, say, US domestic, I would say that we will see a rebound because the growth level will come over the top of it as well. When we look at, say, European, it will be different. A slightly different one, but we've also got a group of people, generations that are coming behind that, we may see certain groups disappear, we may see new groups appear and rebuild, and have not had that sort of previous experience. So I think the growth will distort the figures a little bit, but certainly it won't be the same demographic, I don't think. Obviously, we're in the aviation industry, which means we keep it propped up anyway.
Yeah, I think that covers sort of that business conference and events. I am a believer in winning new business and forming new relationships. You really do need to be doing that face to face. But I think our own experience here is when you look at the success of our own webinars. I'm not doing this to make myself feel good. I'm just saying the reach that we have. When we can get 500 or 600 people engaging with us on a webinar. That's a fantastic number of people. So I think that, however, we are in the technical and asset management business as well, and I think we will be asked questions in the future as to whether we really do need to fly our folks from Europe to Australia, or whether we should be having local resource. So I think there'll be a lot of businesses like that as well, looking with the environment and sustainability angle in the future as well.
Just we can do technical inspections with drones.
Yeah, of course. Yeah, I'm sure that will be accommodated. Although flying a drone over an airport is not actually permissible in most states. You can try that if you want to, and we'll promise to visit you. Yeah. Mike, you mentioned sort of lease rate factors. Is it fair to say some of the sale leasebacks that we've been seeing, has the lease rate factor been better, or is the absolute lease rate that's been negotiated how do you think that would have compared if those sale leasebacks were being performed a couple of years ago? Could you just give us a rough idea? I mean, maybe use some EasyJet A320s as an example.
Yeah, I mean, I think from some of the transactions that we've seen through the pandemic, perhaps we have seen an improvement. I'd definitely say that we've definitely seen lease rate factors improve, particularly as we've seen things like swap rates come down. I think some of those EasyJet deals that you'd point to there, we've still seen some of those in the 0.5% range. I think this will be an effective improvement if you factor in the cost of funds as well. I think you've generally seen more commonly lease rate factors pushing up into the 0.6s, I would say. It's focused more on those newer technology types, A320 Neo families. We've seen some max sale leasebacks even while the aircraft was grounded during the pandemic. So I think we've seen the pricing come down, but we've certainly seen the lease rate factors improve on some of those deals, but perhaps not as much as maybe we would have expected in some cases.
Yeah, thanks. Sorry, Stu, carry on.
I think there's still a level of desperation that still has to come, you know, from the lease rate factors, but also the term length as well. I mean, Mike, what sort of length of terms? Are you still seeing the same or slightly longer?
Yeah, we've not seen too much of a shift in terms of those deals, really. Not on terms of the new aircraft, at least. I think we're seeing pretty similar to what we were seeing pre-pandemic there.
So in terms of, could we see a situation where aircraft economic life could increase because airlines won't be replacing fleets? You know, they'll be keeping hold of the equipment. Whilst they may well have wanted to move into some of the new technology equipment, maybe that won't be affordable, or would that be counterbalanced by, you know, early retirements? Have you got a view on that? I mean, I'll go to Mike first. Is there are we looking at economic life increasing on some of the more popular aircraft, or is that just wishful thinking?
It does feel a bit like a wishful thinking. I don't think we would see the economic life increasing necessarily. We did think earlier on in the pandemic about, because the fuel cost is so low, maybe we would see airlines keeping those older aircraft on for longer. What we've seen really is a clear out at the older end of the market, the older technology aircraft being divested of, primarily because that's been in some cases the easiest capacity to shed, where those operators have had to reduce the capacity within their network. But for many reasons, and not least of which, you know, the environmental aspects that you raised on your slides, Phil, I think we have seen a movement towards the newer, more efficient aircraft types, and I think operators will come out of this with a simpler, some cases smaller fleets, but it'll be focused around those younger, more efficient types. I think that's what we expect to see, and we might see some earlier retirements of some of those mature narrow body and wide bodies.
Mm-hmm. Yeah, just so I'll just step in because so we are getting close to, I think we should probably wrap up at some point very shortly, but a few of the questions we've had on the freight market, we are going to be doing a freighter webinar in the next month or 6 weeks, so we'll get back to you on those ones. In terms of, we have had a question about the specifically about the order and cancellations and this year's deliveries. Are we expecting more delivery postponements? I mean, Stu, I think you've alluded to, you know, we're not out of the bad situation yet, so we're just going to see more deferrals, aren't we?
Yeah, I think that there are ones that were expecting their first deliveries, you know, next year, and so they're making that decision now. Certainly, the more that the process and the vaccination processes continue and the restrictions continue, we will see the 2022 and 2023 deliveries now going through discussions of postponement that weren't delivering before. And you know, similar to touching point, what Mike, the last question was, you know, it will depend on the operator, you know, so it's all mixed in with the economic life debate as well. So, you know, if I'm looking at, say, you know, low-cost carriers like Ryanair or Wizz, you know, and Indigo, then I would expect a large number of some of those ones to come in as we've got exits that are coming through, and they will be looking to the market to finance those. When you're looking at, say, some of the US carriers, you know, they're dumping a lot of the very old stuff, no surprises there, and they're trimming down the fleet, you know, so a lot of trimming down. So I would say there's going to be a mixture of trimming from both ends, deliveries in one way and old stuff the other. But I would certainly say we are expecting more.
Okay, good. Well, look, for those of you who we haven't got back to either online by answering the questions directly before this session or the ones you've sent during the session, we will get back to you individually on those. So really do appreciate the attention that we've had during the course of this session, and I'm quite pleased that we continued, because there's still several hundred of you listening to us. However, I will wrap up now, as this slide shows Insight IQ has come on leaps and bounds, and Stu's demonstration of that. So if you do want to request a demo, do please get hold of us. If you do have more questions once you look through the content of today's deck, then again, please do get back in touch with us. So thanks for attending today's session. You will receive a follow-up email with the link to view the recording of today's session and the slide deck, of course. So on behalf of IBA, Stu, Mike, myself, thanks for joining us today. Special thanks to our marketing team of Melissa, Lucy, Dom and Abby. I think it might be Melissa's birthday today as well, so happy birthday, Melissa. And thanks for all your help. Bye, everyone. Bye.
Bye-bye.
Bye-bye.